the CEO of the Executives Club of Chicago. After 2 years, welcome back. It is such a pleasure to see all of our members and guests and friends and alliances here for our 43rd annual Economic Outlook, live and in person. Thank you for joining us today. I also want to give a big round of applause to Terry, Dr. Bob, and Diane, who kept it all going through pandemic disruptions. We had thousands of people log on for virtual events in the last 2 years, and because of them, we didn't miss a beat. Thank you for hanging in there. If this is your first Exec Club event, if you're a guest, please be sure to visit our website to learn more about becoming a member and upcoming programs. We have a bunch of people to thank today. So I'd like to take a few moments to recognize the Exec Club leadership that is here with us today, beginning with the Executive Committee of the Board of Directors. Our Board Chairman, Scott Swanson, PNC Bank. Our immediate past Board Chair, Dean Harrison, Northwestern Memorial Healthcare. First Vice Chair, Linda Imonti, KPMG, and Second Vice Chair, Chris Shavink, Shure. Thank you all for your tremendous service on the board. Next up, we have the other members of our Board of Directors who are here with us today. Jeff Adkins, BBDO, Wayne Bush, NTT Data, TC Chatterjee, Griffith Foods, Marcia Cruzan, US Bank, Wendell Dallas, Nicor Gas, John Holmes, AAR Corp., Stacy Janiak, Deloitte, Tom Kunst, United Healthcare, Tim Line, Antares Capital, Beth Marion, Accenture, John Martin, Victory Park Capital, Joe Nelligan, Molex, and Amar Paul, Schneider Electric. Our past board chair, Tanise Paul, Imran Qureshi, WTW, Dan Ryan, JLL, Tom Shanley, Lurie Children's Hospital, Laura Tone, PricewaterhouseCoopers, and Carl Vanderwilt, Emeritus. Thank you all. And finally, thank you to everyone who serves on our councils of advisors. Thank you for your leadership and commitment to the club's mission of connecting and growing the Chicagoland business community. Now I want to thank all of the sponsors who make everything at the club possible, not just this program, but every single thing that we do. Special thanks to the presenting sponsor of today's program, BMO. In a moment, Michael Miranda, National Head of Research and Investments at BMO, will be up to introduce our speakers. I also want to thank all of our featured sponsors of today's event, Antares Capital, Barilla, BDO, CDW, CIBC, Chicago Cubs, Discover, Duchossois Capital Management, Energy BBDO, HCSC, JLL, JP Morgan Chase, KPMG, Molex, Nicor Gas, Northern Trust, Northwestern Medicine, OCC, PNC Bank, Robinson Resource Group, Schneider Electric, US Bank, and Victory Park Capital, as well as our supporting sponsors, Mercer, Wells Fargo, Protiviti, and Riveron. As you can tell, the business community is out in full force supporting this event. Thank you all so much. Okay, just 2 quick housekeeping things and I'll stop talking. So first, there's a program, there's a note you can text questions to Terry. I know she's gonna do her best. You text exec to 22333. She'll try to get to as many as she can. And then also, we're in the midst of developing our strategic plan right now for the next few years at the club. We could really use your input. At your table, you'll see a QR code that brings you to a link to do a very brief survey. It's just 5 minutes. I promise you it is not that long. If you can please complete it for us, you'll get a Starbucks gift card to enjoy a warm gift on us. We're really grateful for your time. Thank you, Francie, for doing it. We really appreciate it. Take 5 minutes. It'll be open for a few days. So if you can't get to it today, you can do it after. Okay, that's it. On with the show. Please enjoy your lunch. Before we welcome Michael to the stage, we're going to have a special video from BMO. We'll be back in a few minutes.
Good afternoon, everyone. I'm Mike Miranda, National Head of Research and Investments at BMO. Thank you all so much for joining us today. We value sponsoring this annual program and are grateful to the Executive Club for our partnership. Returning to speak at AEO this year are Dr. Bob Froelich, owner of the Kane County Cougars Baseball Club and former vice chairman at Deutsche Asset Management, and Diane Swank, chief economist at KPMG. We are pleased to welcome last year's special guest, John W. Rogers Jr., chairman and co-CEO of Ariel Investments, to our impressive panel this year. Now I'd like to introduce our panel's moderator, Terry Savage. The name Terry Savage is synonymous with the annual Executive Club's Economic Forecast Luncheon. This year marks her 43rd year at the helm. Terry needs little introduction to many of our regulars here, but in case you are new to the club and Chicago, Terry has written 4 best-selling books on personal finance and writes a nationally syndicated column for Chicago Tribune Content Agency. She appears regularly on WGN Radio and WGN TV. Terry was a founding member and first woman trader on the Chicago Board Options Exchange, and an early member of the Chicago Mercantile Exchange International Monetary Market. For the past 20 years, she has served on the board of directors of CME Group. Terry was also the first woman director of McDonald's Corporation and on the board of Pennzoil Quaker State. Terry also spends her time giving financial planning programs and explaining the importance of employee benefits, investing, and money management. Speaking of money management, we are all excited to hear this year's forecasts. Before Terry begins, we ask you all to enjoy a video recap from last year. And with that, we welcome Terry Savage.
Oh my goodness. And that is why you're all back this year. John, you were shooting bullseyes last year. I mean, that was incredible. We're looking forward to this. All right, well, that was 1 year ago. I welcomed you online, and my opening words were, "We made it." It was just such an accomplishment a year ago just to have survived. Now, we're here in person. Take a look around. That's the biggest change in the past year, no matter what you think about the markets. Fingers crossed here, but we are no longer intimidated by COVID. Happy New Year. Now, as is typical, I go over a little bit of a recap of what happened in the year, just in case you forgot. The video was terrific, though. Last year, 2022, was truly a headline-making financial year when you add it all up, or perhaps when you subtract it. A year of surprises and of extreme volatility. In fact, last year was the 6th worst year for the stock market volatility since the Great Depression. When we met at this time last year, we didn't know that within 4 weeks our world would be dramatically changed by the Russian invasion of Ukraine, impacting oil prices and gasoline prices, which hit a nationwide high of $4.99 average in June, over $6.50 if you lived in California. When we met a year ago today, the Fed funds rate was 0. I had to go look that up twice. I just couldn't believe it. It was 0 a year ago today. Now it's over 4.25%, and several Fed governors have recently said publicly they expected to see it go over 5%, including the Fed chairman. And amazingly, it wasn't until a month after last year's forecast luncheon that Fed Chairman Jay Powell officially retired the word transitory to describe inflation. What a year. In last year's introduction, I pointed out that Facebook had become Meta, NFTs were selling for $90 million, and meme stocks were all the rage. What a difference a year makes. A year ago, Sam Bankman-Fried was just a fuzzy-haired crypto guy buying political influence. This year, his name and his company, FTX, are synonymous with one of the greatest financial frauds in history. 2022 was a year when Twitter was taken over by a twit, causing Tesla to drop into the vortex, more than 65% loss, along with Meta as well. 2022 was the year when Tom Brady found out he could not only lose in football, but in divorce court and in the crypto markets. For all of us ordinary people, 2022 was a year mortgage rates doubled from 3.22% last year at the time we met to over 7% in October and about 6.5% today, sending home buying into a tailspin. But savers, all you people who waited and waited, they were finally rewarded as they ran away from low bank deposits, sorry all the bankers here, I helped in this, to purchase good old-fashioned Series I savings bonds, which for 6 months were paying 9.62%. That last-minute buying frenzy knocked out the computers at Treasury. 2022 was a year of a very close national election that is already having an impact as we bump up against the national debt ceiling of $31.3 trillion this year, and will stir the pot for the presidential election next year. Oh, and speaking of pot, interesting financial statistic, marijuana sales hit a record $1.5 billion in Illinois last year. That was the high of the year. I know one of our panelists did forecast that commodities would have a great year. Okay, let's take a look. Give a picture being worth 1,000 words. Remember, you forecast too last year, and I kept track of your forecast too. So let's take a quick look at the numbers and see what really happened in the markets and how all of you voted when I asked, and you're going to get a chance to vote again. First slide. The Dow Jones Industrial Average. All major market indices had a terrible year last year, but I have the clicker here, right? Yeah, there we go. But the Dow Jones Industrial Average was the least worst of all. After a gain of 18.7% in 2021, the Dow fell, dropping 8.8% last year. Now, last year when we were here, the Dow was trading at 36,290. I make these charts up late the night before, but we've had a rally today of 300 points, so we're now 34,250 plus, so down a couple thousand points from this time last year. The broader-based S&P 500 index had a doubly tough year since it was filled with out-of-favor tech stocks. After being up nearly 29% in 2021, the S&P lost nearly 20% last year. When we met, it stood at 4726. Last night, 3969, having dipped just below 3,500 last fall. And pity the poor NASDAQ. It lost 33% in 2022, posting 4 consecutive losing quarters for the first time since the dot-com crash of 2001. Last year, the NASDAQ stood at 15,818 as of last night, 11,402, but in the fall, it dropped as low as just over 10,000, 10,088. All in all, the markets really crushed most investors' portfolios last year. Now, not only were stocks down broadly, but bonds had their worst year ever. Remember, rising rates pushed bond prices down, and so all the conservative investors who had like a 60-40 portfolio, 60% stock, 40% bonds, they lost money everywhere. So, you think that's really been a big year? Last year, every year we ask for you to give a forecast. So last year, here's what you said. I gave you a broad range, over 40,000, 20% of you. Between 30, remember, we're at 34,000 now. Between 36,000 and 40,000, God, the vast majority. We had a few bears. 30% of you, according to my notes, said that you would think the market would be under 36,000 after our big tear of the year before, okay? So before we ask for our panelists' forecast, and don't look at Dr. Bob. Honestly, I emailed him, I said, don't tell me, I don't want to know what you're going to say. And you're on your own here too. Let me give you a little slightly wider middle range bracket, okay? I'm going to ask you, I'm going to give you your choices, over 40,000. Now it's a broad middle bracket, 36 to 40, and I want to know if anybody thinks it's going to be under 36,000. So raise your hands, it's the only scientific way. Bulls, raise your hands. Dow over 40,000. Dr. Bob, don't vote. Bulls, any bulls? No, one, not even one. Wait, come on. Somebody who thinks it's going to be over, one. Come up to me afterwards. I want to meet you. I want your card. Okay. One person. Okay, I want to see if we have any bears. I'm going to go for the bears. How many think under 34,000, which is where we are today? Okay, bears, raise your hand. That's bears. 1, 2, 15, 16, 18, 22, 20, 30, 40, 45 people. Okay. Okay. All right, all the rest of you think it's right going to be about between 36 and 40. That would be actually a good year. Yeah? Raise your hand. You're in the vast majority. You can't lose, right? Okay. Well, let's see what happens. Okay. Next, the 10-year Treasury note. Last year, it was the 10-year Treasury note. Remember, it was a terrible year for stocks and bonds. Treasuries lost 39%. 10-year Treasuries lost 10% of their value. And that's, of course, what makes mortgage rates. A year ago, it was at 1.73. I'm going to ask you to vote again. After having fallen below 1% during the pandemic, remember? Today, the 10-year yield, now, this chart last night, 354, we had some good inflation news, relatively good, I guess, inflation news today, and so it's 344 as we speak. Last October, at the height of the Fed rate-raising spree, the 10-year yielded nearly 4.25. So I want you to know, I looked at my notes last year, 99% of you forecast higher interest rates. We'll do the panel in reverse, we'll ask them, okay? But I'm going to do it the same way again. Higher or lower? Let's see. I'm not getting, there we go. Okay, how many of you, I'll do it right now. How many of you think the interest rates will be higher than today next year at this time? Higher, raise your hands. That's only about 20%. How many think interest rates will be lower? Wait, what do the rest of you think? You aren't thinking. You have to do this. All right, again, how many think interest rates will be lower? They're not going to be the same. Only another 25% think it'll be lower. The rest won't vote. Okay. See if we serve you lunch next year. Okay. Okay, just a few more to go. We set the stage for our panelists. Inflation. Now, this is interesting. This is a 20-year chart, and this is what got everybody so crazy. As John correctly forecast, 2 months after the election, it hit 9.1% year over year. This morning, we got the news that the CPI was, for the month, was minus 0.1%. That's the first time since the pandemic started that inflation fell. It's still 6.5%, the headline number, year over year. So, as you know, John really did nail that one last year. Okay, now. Nobody talks about oil anymore, but I thought we ought to put it in. It's a tough chart to read. But last year, 78, this year, 75. But wow, what a wild ride in between, because the Ukraine war took it up as high as $120 a barrel. And now this one I've been waiting for. I don't know if you can see that very well either. Okay. All right. Okay. A year ago, we took this chart seriously. Okay. Bitcoin was trading at 42,400. And now it's been locked into trading range between 16,500 and 18,000, although just today, it's now trading a little over 18,000. It's had a 5 or 6 day rally. Now, we should have seen this coming. But John Rogers, as you heard in the video, compared Bitcoin to tulip bulbs. If you don't know what tulip bulbs are, you must read Extraordinary Popular Delusions and the Madness of Crowds. It is a legendary book detailing mass manias going back centuries. Anyway, John called it a tulip bulb. He said the price would go down 30 to 40%. The price is down 60%. But that's okay, John. You were very, very much in the minority last year when you forecast that. And now, one more critical issue. Let's do this. GDP. This is 21 and 22. And the real question we're asking here is, will there be a recession in 2023? Yes, at the beginning of 2022, we had 2 slightly negative quarters. Nobody has labeled that, including the National Bureau of Economic Research, as a recession, because the economy came roaring back to grow at 3.2% in the third quarter. Big surprise to many. And the fourth quarter final is still a question mark, but the latest estimates show it at a growth rate of 3.5%. So the big issue for our panelists is, will that growth continue in 2023, or will the Fed push the economy into a deep recession as part of its ongoing fight against inflation? And now it's your turn. Let's ask for your forecasts. The Dow, the NASDAQ, interest rates on the 10-year Treasury, GDP, what we're asking about is recession. Unemployment, if you care to comment. Inflation. I'm going to give you a toss-up category, Bitcoin and gold, because gold's just bumping up against $1,900 an ounce, just kind of waking up out of a deep slumber, despite all the inflation. And our most popular closing forecast, what would you do with $100,000? So it's time to get started. Now, I have my handy chart here, and if anyone wants to quibble, I have the same chart from last. It was kind of easier to do on Zoom, but I have the same chart from last year. I wrote down what they said, write it down again, and we'll keep track, wishing you all come back in good health next year. Let's start with Diane Swank. As always, we start with our longtime panelist and good friend, Diane. Well, Diane has joined us for many years and has always had a great focus on the economy. Her home base has shifted as she has moved ever higher in the firmament of economic stars, from first Chicago to Mesereau to Grant Thornton, and now as chief economist at KPMG. You may remember that Diane wrote a terrific book called The Passionate Economist. I think the sequel is going to be titled The Peripatetic Economist. Diane's list of honors and awards would take all of her speaking time. She's a fellow of the National Association of Business Economists and serves on their statistics committee. She regularly briefs the regional Federal Reserve banks and the Board of Governors in Washington, D.C., and is involved with such a beautiful long list of charities in Chicago. Now, as you saw in the video, last year Diane's forecast included concern about home prices, noting we were close to a housing bubble. She nailed that forecast and broke the bubble. Mortgage applications now down 50%. She was really close on her stock market and energy forecasts, and right on in her GDP forecast of growth of 3.5%, where we are now after 2 slightly down quarters. And while we can never pin Diane down to specifics, last year she decided to split her $100,000 windfall between bets on volatility and bets on cash. Both were winners. So Diane, let's see what you have to say this year.
Wow. It is good to be here in more ways than I can possibly let you know. I'm dressed for the occasion, the message that I have to give. My daughter is getting engaged. I am in black. No, it's actually really good. The reason I'm in black is because I'm humbled. My daughter's been in her relationship with her high school sweetheart longer than some of my marriages. People wanted to know about my family. You're going to hear a lot about them today. So it's been 3 years since I stood in front of you, and it is really good to be here. And before I turn to the economic outlook, I want you to lay a context for where we are. And I want you to think of 3 words, because they're going to be important in understanding the context of where we are. The first one is resilience. It's truly remarkable that less than 3 years after a 100-year pandemic and the worst contraction in the economy on record, we're at 3.5% unemployment rate in December of 2022, the same as it was in February of 2020. The second word, reflection. The pandemic accelerated trends already in place and catapulted us through Alice's proverbial looking glass into a world that is a mirror image of the world in which we left. In many ways, it is the reverse of the world in which we left. It is a world much more susceptible to volatility, uncertainty, and supply shocks. Everything from geopolitical risks, as we saw with Russia's invasion of Ukraine, the UK acting like a banana republic. Didn't have that on my bingo card either. I actually have a friend who did an analysis of if we kept seeing prime ministers turn over in the UK, what would the rate be a year from now? We'd have one every couple of seconds at the rate they were going. Math is fun, isn't it? And then we also had climate change starting to disrupt more things. And we have supply shocks also in what is becoming an aging demographic and acute labor shortages across much of the developing and the developed world. Those changes have changed something else that's very different than the world in which we left. We are much more sensitive, this is new, much more sensitive to interest rate cuts than interest rate increases. This is something the Fed understands. The economy responds more now to interest rate cuts than interest rate increases. That is really important for where we are, and it's many reasons why the Fed keeps pushing back every time the financial markets ease financial conditions. It ups the ante on the Fed to raise rates more. And they'd rather that the financial markets would not front-run them so much. The third word, and we're going to get into why that is, the third word I want to leave with you is one that I started with, is humility. My children have humbled me dramatically, but so is the economy. There is no magic 8-ball. All I can do is paint a picture of where I think we're going and hopefully give you guideposts for where to turn when things go differently. It's even more elusive today. Not only are the data not capturing the speed with which we're changing, even with high-frequency data, it's harder to seasonally adjust data in a world coming out of a pandemic. And so there's quirks in the data, including today's CPI data. They're under-measuring medical costs, which is one of the most important services that are out there. The Fed knows that, but other people looking at the data don't know that. Those things are important to understand because not only is it harder to forecast, it's harder to measure an economy that's moving this quickly, even with more high-frequency data, which is an elusive sort of, it's a blessing and a curse in itself, because the speed with which high-frequency data moves, we don't have a history for it. And it could tell you yesterday when almost 4,000 flights were down, as the FAA went down, that all of a sudden no one was going through TSA checks, so that all of a sudden that collapsed in the economy, that travel collapsed. Well, no, it hasn't. So it's important to understand that. So now let's turn to the economic outlook. Well, two things matter for the economic outlook at the moment. We could have a lot of things change between now and the end of the year, as we all know. The number one issue is the trajectory of inflation. And the number two issue is how does the Fed react to that? And I think it's really important to understand where the Fed is at. They keep doubling down on their pushback against financial markets, front-running them and rallying and easing credit conditions. Why is that? The Fed's doubled down on its pledge to derail inflation, even though they believe that requires pain, which in their verbiage means an increase in the unemployment rate. Their baseline forecast in December, which they still are standing by, is for the economy to stall out in 2023 and the unemployment rate to rise more than 1% than it did from December of 2022. That's not exactly a pleasant scenario. Their goal is to cool inflation faster than they cool wage growth so that wages can once again outpace wage growth. But they're willing to risk overshooting on rate hikes on the upside rather than undershooting and reflating an economy that's more prone to inflation and more responsive to rate cuts than the one in which we left. My forecast is that's a pretty hard thing to calibrate, and that the Fed overshoots in their desire to hedge against what they see are the worst outcomes, and I'll get into why they see that, and that we get a mild recession. Fed-induced recessions were more sensitive to rate hikes, barring a financial crisis. Fed-induced recessions are easier to recover from, and so it should be a mild recession. Now, with my forecast, you get more of a cooling of inflation than the Federal Reserve does, and you can cut rates again by the end of the year, but you're limited in how far you can go because this economy is more responsive to rate cuts. That's a very different world than the world we left. The Fed sees its battle against inflation as more of a marathon than a sprint. In the first phase, getting down from 9.1% to 6.5%, easy. A lot of help from energy prices on that. But also goods prices have come off, some of the supply chain problems have unwound, this is all good, we love that. But what they're worried about is that the next phase includes the hardest mile between 18 and 21, where your mind and body hit a wall. If you don't, at that point, focus on getting across the finish line, you're going to stop short. And history is littered with central banks who stop short of crossing the finish line. And as a result, suffered inflation, a longer bout of inflation, or stagflation. The Fed knows those lessons well. The world is different. They could be wrong, but they're going off of that hedge. The stakes are even higher because labor market shortages we are facing are now structural, not just cyclical. That means wages and prices tend to get sticky and can set a floor on how low inflation can fall. And if we're not careful, given the risks of additional supply shocks from China's abrupt end to its zero COVID policies and Russia's threat to retaliate against NATO countries for sanctions with cyber attacks and physical attacks, including attacks on our energy infrastructure, there is a very high risk of yet another round of supply shocks in 2023. The labor market tightness is one of the largest imbalances we have in the US economy. I'm a labor economist. Labor force growth between February of 2020 and December 2022 grew 0.3%, 508,000 workers. Demand for workers on the margin, job openings at the end of November 2022 was 50% above the level it was in February of 2020. 3.5 million workers more were demanded. That's a huge imbalance. There's no way to get there unless you both hammer demand and raise supply via an increase in unemployment. Add to that the staffing shortages that in any given month we have because, yes, we've decided it's an endemic, but a trifecta of RSV, I didn't even know what this was, flu, COVID, means that we're accepting an unusually high level of infections every month. In December alone, the number of people out sick and unable to work was at 1.5 million, 60% above the average monthly of those people out sick in the 2010s. That's a lot of staffing shortages. We also, December, by the way, was the largest month on record since the data go back to 1976 for December of people out and unable to work because they were on vacation. That revenge travel was there. Just hope they weren't flying a certain airlines. I won't say names. I can't. We might audit them. I don't know. Where have all the workers gone? Baby boomers are retiring. And some people like my incredible office managing partner, Linda Amati, is retiring early and leaving us. Love you, Trevor. But, I got to know Linda and have bonded. And you're leaving to ride motorcycles. Now you know why I joined KPMG. I don't ride motorcycles, but vicariously, I live through Linda. I have to do this, Linda. This is part of my job, right? She didn't know that I was going to do this. That's why I do it. What's been amazing, 1995 to February 2020, participation rate among the over 65 crowd rose. Kept rising. They wanted to stay. We want to work. They had to. Couldn't afford retirement. Since then, they fell off a cliff and are not coming back. There's a lot of reasons. Women, twice the time or pace of men, say they're taking care of family. Children, there's a child care crisis out there, and elderly parents. There's a crisis in long-term care as well. Prime age women, 25 to 54, I'm no longer in that prime. Anyways, passed it a long time ago. Their participation is back to pretty much the levels of February 2020, not to the peak of 1999, but back to the levels. That's despite the fact we have a child care crisis. Pretty amazing. These prime-age women are coming back. Prime-age men, they're still lagging. Prime-age male participation rate peaked in 1954 in this country. And every recession since, they've lost ground and never come back. This is not something new. This is despite the fact we have lower safety nets in the United States than anywhere else. We are last for female participation and male participation in the G20. That's 80% of the global economy. Last. Canada, our neighbors to the north, 12% higher participation rate among women in their prime age than here in the United States. It's mind-boggling that we would cast so much talent aside when we need all hands on deck. And there's a lot of reasons for this. Same time, women are now, starting with millennials, out-achieving men in educational attainment. 60% of college grads are now women. And the pandemic only accelerated those trends because women weathered the pivot to online better than men. More men dropped out of high school and more men dropped out of college than women. So if you're not talking to a lot of women when you're doing interviews, you better rethink your strategy. My son reminds me a lot. He identifies as a millennial even though he's really a Gen Z, and that's okay. He reminds me of why millennials are so angry with us. He actually, we were a few blocks away, about to watch a comic, his favorite comic, and we were having a deep discussion, as we always do. And he said, "Why isn't Gen Z more angry at the baby boom?" We are. And he had good reason. And he'd list off the litany of reasons in his life, but the reality is millennials are the first generation where economic mobility stalled, where a larger portion were unable to exceed the incomes of their parents or even buy homes. And they're still waiting, and they want to buy homes. It also is a generation more determined by where they lived in their zip code on what their future would be than their talents and their abilities. That's a waste. The largest, most diverse, most educated generation we've ever produced has been hit harder because they came of age in the 2000s. And that's important. I'm going to end where I started with the 3 words, but some optimism. Resilience. It's remarkable that we are where we are, and for me personally, to be here today. Over 20 years ago, I was in the World Trade Center on 9/11, and during the pandemic, I found my body riddled with cancer as a result of that experience. Since I've been in person with you, I've had 11 surgeries, and I'm still here. Next word is reflection. I spent a lot of time reflecting on my last couple of years and what we've all been through. And grief hits you in an odd way. And it finally all caught up with me. In a rare moment of vulnerability, I shed a tear with my daughter. And my daughter leaned into me as I was sharing difficulty that I was dealing with. And she put her arms around me and she said, "This is what families are for. To stand by you no matter what. You have done that my whole life. I love you." And in that moment, I realized our future is bright. Thank you.
well, that's hard to follow, but I am duty-bound to ask you to help me fill in at least a couple of the boxes on my chart. So, Dow, we're at 34,000. Dow where, year end?
34,100.
Taking a page out of Dr. Bob's book, okay. I want to ask you about the NASDAQ, but interest rates, a 10-year Treasury now around, call it 350.
3.2.
3.2, lower. Okay. Are we going to have a recession, Diane?
Yes, a mild recession that we recover from. I hope I'm wrong, but I don't know. Would you rather I have a 5.3% unemployment rate at the end of the year instead of the
really?
Fed's
5.3%?
5.3. Still low for a recession, but not to those who get laid off.
Okay. What about inflation? The year-over-year number, which today was 6.5. Forget 1 month down, so many months, whatever.
By the end of the year, I have inflation falling below 3% on the CPI, overall CPI. That's barring a major secondary energy shock to about 2.8%. That is part of what allows the Fed, you have to get below the 3% handle on a little different measure of inflation for them to feel comfortable in actually easing rates. I have the Fed peaking at 5.25%, although they're willing to go further if necessary, and then cutting by 1% by the end of the year. But it's really hard to go. The model, trying to do scenarios on this, we're going to have much higher interest rates for a while, unless we have a full meltdown, but we're going to have higher interest rates.
I'm coming back to you all on that question, because it has, the question of higher interest rates and how long they'll last has implications for all of you in your life, so I want to come back. But peaking maybe at 5.25 on the Fed, but inflation coming down. And I just want to hear you re-say that while we're right here, that you think it'll take the inflation headline number or whatever the core or whatever the Fed's following to see something maybe a hit below 3%
before they feel,
go,
yeah, because they can't stop. People are saying, why don't we stop at 3%? That's fine. They can't do that. Well, to quote someone, Neil Kashkari, who's the head of the Minneapolis Fed at the Jackson Hole, Wyoming meeting, someone suggested on stage that, it was public, the press was there, on stage that, they change the goalposts and stop at 3. And he said, you can't do that in a raging inferno. And what he meant by that was that, when you're fighting inflation, you can't look like you bring the finish line shorter. You can't stop short.
Okay.
And so that's why they are really stuck to the 2% inflation target. What they really want, the bottom line is, they want inflation to no longer distort economic behavior. And we know that somewhere around 2, it no longer does. Now, over time, they could change their mind.
Really quickly, you cannot duck me, because you were so good last year. $100,000. Tuition's paid. Gosh, your kids have graduated. I don't even have to caveat that.
No, they're in graduate school now.
Yeah, right. Okay, $100,000.
Both of them, yeah.
How do you invest it?
And my daughter's in New York with her boyfriend on my dime.
$100,000. $100,000. Everybody here would like to have an extra $100,000.
So, I'd put 6 months into, last night, the 6-month T-bond was at 4.91%. So I'd put 6 months into a Treasury bond and then go all into Treasuries, because we'll have a rally in the Treasury market by the second half.
Say that again?
Go all in on Treasuries.
All in on Treasuries.
After,
what maturity? Not the distance,
we're going to see a rally across the board. The biggest rally will likely be closer to the 2-year, 5-year area.
So are you ready to put the whole thing in Treasury of some maturity shorter
After
than
6
5?
months.
Pardon?
After 6 months.
After 6 months.
Because it's going to get worse before it gets better. But I want to lock in my 5% first.
Okay, good for you. All right. Thank you very much. You really were helpful this year. This was great. All right. Oh, I got to do more introductions. Okay, let me find the rest of my introductions. My goodness, I was so mesmerized by all of that. I bet I can do this by heart. John Rogers, you're next up. The guy with a bow and arrow that actually bullseyed every single thing he forecast last year. But I want to say a few things about John, although he's so well known in Chicago. He founded Ariel Capital Management, the first Black-owned investment firm in the United States. And this year, Ariel will celebrate its 40th anniversary. Congratulations. The firm's flagship fund, Ariel Fund, has one of the longest track records in the industry. It is the only mid-cap value fund in the U.S. today that dates back to 1986. All the others get wiped out, and they lose, and they fold them into something else, you know? John is the longest tenured portfolio manager in Morningstar's mid-cap value category, and his is the only mid-cap value fund in the U.S. today that goes back that far. You know, I look back and found out if you invested $10,000 in Ariel Fund in 1986, it would have grown to $332,553 as of September 30th. And do you remember in 1986, I think that was when I interviewed you. Why was I busy interviewing you and not just investing with you? I don't know. Well, you heard John's absolutely correct forecasts about everything from Bitcoin and bonds, which he called a loser's game, and of course his correct prediction of 9% inflation, telling us to hold cash, which was then yielding literally nothing, and now, as Diane mentioned, paying nearly 5% in T-bills, and to buy dividend-paying stocks. So that has been a fantastic forecast for the year. What does John see for 2023? John Rogers, please take the podium.
Thank you so much, Terry. It's great to be back, and we've been friends for, it's like going on 40 years, so it's pretty amazing. So thanks for including me today. So I'm here, you know, we already heard the extraordinary, well-crafted talk on what's happening in the economy, and so I'm just here to hit some of the highlights and some of the headlines of how we're looking at things at Ariel today. So we're much, much more optimistic today than we were a year ago. You know, a year ago, it really was a time when we did think it was a bubble category in a lot of ways. And we saw all the enthusiasm everywhere you went. People were excited about the markets. It was a place to be. People were excited about the risky assets of the hot growth stocks like Tesla, et cetera. The top 5 companies that were inside the S&P 500 that drove so much of the performance. And of course, we talked about Bitcoin and some of the other type of asset classes that were out there. The thing that we didn't see last year was we didn't see the war in Ukraine coming and the profound impacts that would have on energy prices and commodity prices broadly. We didn't have that kind of foresight. So looking at today, we're in an entirely different scenario. I think the bad news is behind us. Everywhere we go now, people are really fearful. You know, I talk to people who are all telling me the recession is coming. Everyone you talk to, whether it's my 32-year-old daughter or the guy who delivers the pizzas from Gino's. You know, I mean, last year he wanted to buy the Bitcoin. So I really do feel that this bad news is baked into where we are in the economy today. And so I'm much more optimistic about the markets. I think that we will not see a recession in this year. I think that is all baked in. Everyone, again, is fearful about it. I don't think that's going to happen. I think the Fed has finally gotten smart about the money supply. We know they'd gone way too far, which helped cause the inflation that wasn't transitory. But so many of us here are connected to the University of Chicago and their School of Economics and understand what Milton Friedman brought to us and how important money supply is. Now the Fed is doing the right things when it comes to money supply, and so we think that we're going to have inflation under control, you know, getting back to that sort of 4.5% kind of level. I'm not quite as optimistic as Diane in that way. And I think you'll start to see interest rates settle in around 4%. As it starts to drift back to a more reasonable level that gives us a lot of confidence there. When you look at the market itself, I would not be surprised to see the Dow up over 10%, and maybe even a little better than that. Because the Dow as you know, often has some of the cyclically oriented companies, the kind of companies that will do well if we don't have a recession and the recovery starts to happen. I tell people, you know, that I usually don't like to talk about individual stocks a lot, but I do think there are certain sectors that have just gotten absolutely destroyed this year. And for those of you that like to pick stocks yourselves or pick ETFs or funds that specialize in certain areas, I would hit on a couple of areas. I think that anything that is cyclically oriented, auto-related companies, I think are really well positioned. Some of the companies from a Borg Warner to a Gentex, people that supply the auto industry, we think will do really well. We think anything having to do with housing will do well, and real estate will do well. I saw Dan here from JLL, and thinking companies like Jones Lang LaSalle will do really, really well. Anything having to do with housing, whether it's ADT to Mohawk that makes carpets, we think will have a really good year. When it comes to everyone saying when you have a recession, no one's going to advertise anymore, all the advertising-related companies have really struggled. So our favorite is the one everyone hates is Paramount Global, that owns CBS and Viacom, and of course is a major streaming company out in the marketplace. We think companies that like IPG, one of the world's largest advertising agencies, is really well positioned to benefit as advertising comes back. And it really doesn't matter where the advertising goes. You need to be able to talk to an ad agency to understand where to put your ads in this more complex media landscape that we have in the country. And then finally, without a recession, we think all the sort of leisure-oriented kind of fund stocks are going to continue to do well. I know we're all seeing how busy airports are. We see how busy restaurants are. You go to New York or Las Vegas, it's just jam-packed everywhere. So companies like Royal Caribbean and the cruise line industry, Boyd Gaming, a major company in Las Vegas, even a company like Mattel that's going to have the Barbie movie coming out this year, which we think will be an exciting new opportunity for them. So those are some of the areas that we would be looking at in this more optimistic type of environment. And I look forward to your questions, and I really, again, appreciate the opportunity to be here. Thank you.
Wait, don't talk. It's a man who gets right to it. Okay, let me back up. You said the Dow 10% plus. But the S&P, which was so overwhelmed with tech companies, could you give a comment on that? It performed twice as, well, doubly bad this year, so.
I think it's going to be, I think the S&P could be up a little more than Dow because it had such a tough year last year. And a lot of those top 5 FANG stocks have gotten down to reasonable multiples. You see that a lot of them are down under 20 times next year's earnings, reasonable multiples in a market that's there. So even though I think value will still win, I think the S&P will do better than people anticipated and slightly better than the Dow next year.
Okay. You mentioned 4%. Were you talking about the Fed funds rate when you said, which is expected by most to exceed 5% any minute or in the spring?
Yeah,
Are you saying the Fed funds rate will be 4%?
I was looking at the 10-year.
At the 10-year?
Yeah.
Okay, well, that's up then from the current 3.5.
I think we'll just, keep it right around here. I think interest rates are, they're going to drift lower over time, but it's nothing dramatic. That's the bottom line. It's going to be very sort of a comfortable feeling. And
you were flat out, no recession. Do you have any thoughts on unemployment? If there's no recession, my gosh, could it go lower? Could unemployment go lower? I mean,
yeah, I think the unemployment rate also will stay sort of in this area, but maybe continue to improve over time as the economy doesn't go into recession. But I know right now it's clearly a difficult, people are starting to, the job market's changed dramatically. And it's we see it everywhere, and all of a sudden you're starting to see wage prices go lower and everyone talking about those fears. But I continue to think that the Fed's going to be in a really good place to help to start as we get toward the end of the year, start making the moves to start to get the economy getting lower rates will be really positive.
So do you think when do you think the Fed will cut?
When?
When?
Oh, I think it'll be toward the fall is kind of what we think.
Okay.
Charlie Bobrinskoy, our vice chairman that many of you know, is sort of our lead macro guy. I think you often see him on CNBC, and Charlie's also a UChicago person, and he's gotten quite optimistic around this area.
Around rate cuts in the fall. Okay.
Yes.
Okay, now, ordinarily I wouldn't push you on this because I don't think it's your, but last year you were so right on Bitcoin, and it's like 18,000 now. Are you ever going to look at it again, or do you think it's dead and gone, or what?
I still think it has further to go. I don't see any real value there. And as you know, Terry, we're big believers in Warren Buffett and Charlie Munger, and we think Warren's the greatest investor of all time, and he's been very consistent about the fact that Bitcoin doesn't produce any value itself. And Charlie Munger, I think, called it rat poison. So,
Yes, he has. Yes, he has. Okay, well, let me take you back to before I ask you for your specific, how you're going to invest, because you're famous for this, mid-cap value. That's your sweet spot. That's the Ariel Fund. What do you see for that compared to potentially buying tech now for a giant rebound or energy stocks? I mean, where does mid-cap value as a category fit for the year ahead? Will it be one of the better performing or just match a benchmark?
I continue to think value is well positioned. We went through a 10-year nightmare where value got destroyed by growth. And it was just, everyone knows that. It was just horrible. So many people have given up on value, even after this sort of nice recovery, relative recovery this year. But if you think about it, the generation of great value managers slowly but surely disappearing. So many people have retired, the Ralph Wangers of the world, and they're just the kind of folks. Bill Miller is getting to retirement. Some of the other guys are older. You don't see any young up-and-coming value managers. All the young up-and-coming managers are all in private equity, they're in hedge funds, they're in growth stocks. No one wants to be a value manager. So I think that's where value is and the opportunity is there. Our Ariel Fund's selling at about 12 times next year's earnings, a significant discount to the S&P 500. And it's well positioned in the kind of sectors that we talked about, being concentrated fund. So we think it's well positioned, and we think value is very well positioned here.
Okay, now I'm going to nail you down here. Because you've got $100,000, and you really do have $100,000. I bet more than $100,000 comes into the Ariel Fund this afternoon.
Yeah.
So,
hope so.
That's probably a pretty good bet. Okay.
Thank you.
You can find them. They're in Chicago. All right, now, but consider the landscape. It could be stocks, bonds, it could be anything else. You get $100,000. Where's it going for the year ahead?
Well, I talked to you kind of about what we're doing this year. I think that I would just everyone. It's just being in a balanced portfolio. We can't tell people to put the whole $100,000 in the Ariel Fund, even though we would like that.
But this is just a forecast. This is not telling people what to do. Just where do you think you would put $100,000? This is a kind of a speculative question, not your usual mature, value-oriented Warren Buffett style. Okay? But on the other hand, not that you didn't win out last year.
I still think domestic equities here in America is the place to be. I think we have the best economic system ever invented. We always bounce back for our problems in this country. Warren always talked about last year the Dow Jones started at 66 and ended after 11,000. And we know last century we had many recessions, we had a Great Depression, we had 2 world wars, you had a pandemic, and the Dow just marches and marches and marches higher. So I would just be pretty much almost all in domestic equities with that $100,000. I'd be especially fearful of China. I think that real estate bubble over there is in the process of bursting. And Bob Aliber, another great former University of Chicago professor, has been very much afraid of what's been happening over in China and this idea that it's going to bounce back to its traditional growth rates. We think it'll be quite a while before that happens, so I'd be very, very careful. And I think the international and opportunities, we have to be fearful about what's happening. As Diane talked about what's happening with the war in the Ukraine and the challenges there. So I'm a believer in America, and we have a kind of disproportionate amount of Chicago-oriented stocks, too, in the portfolio. So we love that, too.
Are you keeping any cash in reserve at this moment now, year-end, beginning of the year 2023, for a better buying opportunity? Or, you went back and you said, yep, all in on domestic equities.
We're all in. We're 99% invested, and but we almost always are. We just feel like it's just hard to move in and out day by day. We just like to buy things and own them for the long run and stay fully invested.
And what a great track record for 40 years. Thank you very much, John. Well now, Dr. Bob, you're a brave man. You know, I don't know where I start this introduction. Leave that for Dr. Bob. Dr. Bob is the highlight of every one of our economic forecast luncheons, and year after year, he astounded us in the entire bull market that was most of the past decade with his forecasts that were higher than we would have ever imagined the market would go. Background, you know Dr. Bob from his chairmanship of many firms, the Deutsche Bank and Kemper funds, and chairing investment committees. Dr. Bob's written books that have been seen all over the years. He's really had his work cut out for him, making Chicago's minor league Kane County Cougars successful. We're cheering for you this summer. But we have to say that for all those years of your outrageous bull market forecast that came true, including, it'll be 2 years ago now, 401k, which you translated into Dow 41,000. And then, of course, you were directionally correct last year, far more so than anyone else. But look, here we are at Dow 34,000. Is this going to be the year that Dr. Bob changes his tune? I have no idea. We are all waiting with bated breath. Dr. Bob Freilich.
Boy, last year was a year I really learned something. When you use a crystal ball for a living, you eventually eat a lot of broken glass. I want to give you a foundation to think about for everything I'm going to talk about here, and I'll get into the market stuff, but I want to frame a couple issues. The mind that opens to a new idea never returns to the original size. Albert Einstein said that. The mind that opens to a new idea never returns to the original size. Think about this for a minute. We're never going back from the hybrid work-from-home world. Never. This COVID pandemic changed everything, and if you're still out there wondering, when's it going to get back to the way it was before COVID? I'll help you with that. Never. Okay? It's never going back. Look, I think back to my first job interview. I can't even imagine in my first job interview that I would say, so like how many days do I get to be in my PJs and work from home? No, seriously, man, because if I don't get like 3 of those days, I'm not interested. That's where we are. Let me say it again. The mind that opens to a new idea never, ever returns to the original size. So look at this hybrid work world changed everything so dramatically. Now, the single most important issue for everyone in the workplace today is work-life balance. That's the single most important issue. Because that's the single most important issue, this hybrid work-from-home world, it's not going away. Look, I know not everyone's going to agree with me. There's many that are going like this right now. Most of you are supervisors and business owners who want all people in the office 5 days a week so you can see them and pretend you can control them. We're never going back there again. Look, and I know some of my forecasts don't come true, so I will prove this one to you. I can prove it to you. Anyone remember an old dress code concept? We used to call it Casual Friday. Anyone remember that thing? It was back in the dot-com boom. And businesses said, all right, here's the deal. 1 day a week, okay? 1 day a week Friday, we're going to let you do this. And then it was, well, what about Tuesday after a 3-day weekend? Okay, Tuesdays after a 3-day weekend as well. And then the really savvy HR people thought, I got a great idea. Let's give them a reward of a casual day. Give blood to the blood drive and you get to have a casual day. That's what we did, you know. And overnight, we went from casual Friday to casual every day. It's exactly what's going to happen with the hybrid world we live in. Now, let me shift gears and share with you what I think are the four most important global shifts that are happening. Some are in the economy, some are in the markets, but together they really set the groundwork for what I think are going to be investment issues, investment themes that we have to deal with, not just this year, but probably this year and next year as well. My first investment theme is something I call JIC, just in case inventory, replaces JIT, just in time inventory. I will tell you, the COVID pandemic exposed just how fragile the global supply chain was. In particular, the over-reliance on the whole world with China. This means, as we move to this just-in-case inventory model, this means we're going to see continued deglobalization and a shift from supply chains to what I would say, think of it more like a supply web. We're going to move from a chain to a web. If you think about what happened, everything broke. I mean, come on, we couldn't even get toilet paper. I mean, this was really serious stuff. And that's what chains do, though. When chains are under stress, they break because they're only as strong as the weakest link. When what used to be a global supply chain and look more, now it's going to be this web, it will be multiple suppliers. It will be multiple producers. It will be multiple distributors, and they will transcend across international borders. Gone are the days of this low-cost manufacturing, just-in-time inventory. That's gone. The investment ramifications for this are unbelievable. There will be hundreds of billions of dollars in economic activity as we move from supply chains and diversify into a supply web. Trade will now be more targeted. It'll encourage economic diversity, and it'll increase stability as well. The big winner of this, the big winner of moving to this web will be domestic labor, especially in developed countries like the United States and like Europe that have overly relied on low-cost emerging markets for their labor and their raw material. That's where our supply chain was. It'll be a real positive for our overall living standards as it helps employees that don't necessarily have a specialized set of skills. Second investment theme is something I call, do you want to chat? Do you want to chat? There's a company out there called Chat, C-H-A-T, Chat GPT. GPT stands for Generative Pre-Training. This thing is unbelievable. It's a prototype chatbot, not a robot, a chatbot. You all know what a chatbot is, right? A chatbot, it's a program. It's a computer program, and it's designed to simulate conversations with humans over the internet. And these chatbots, the way they work, it's sort of like a game of tennis. It's like talk, reply, talk, reply. You can do it all day long. I mean, it's really, it's unbelievable. Well, this thing just came out in November. It's developed by a company called OpenAI for artificial intelligence. And they also have another thing that they've worked on, and it's called DALL, D-A-L-L-E2. You write this one down as well, D-A-L-L-E2, and that chatbot is chat, C-H-A-T, and then GPT. Now this DALL, this thing, you go on this thing, think about artificial intelligence. This is like crazy. Whatever you say, it'll create an image for you. So this is like so cool. So you can say, show me an astronaut on a purple horse on the beach with fireworks. Boom. There it is. I don't know how you make money with that, but damn, that's fun, you know? I mean, I was there for like 2 hours like going through this. So, I mean, it's there. I mean, the artificial intelligence is absolutely positively there. And I went back to this Chat GDP and I decided, okay, here's what I'm going to do. I asked it one question. I said, who is the best stock market forecaster? Now, deep down, I was saying, man, wouldn't it be cool if it was like me, you know? It wasn't. It wasn't. Here's what it said. It said, and I quote, "It is difficult to say who the best stock market forecaster is, as stock market forecasting is highly speculative and predictions can greatly vary depending on methods and assumptions. Additionally, past performance is not always indicative of future results." Obviously, a few lawyers work for that firm, huh? Anyway, it's an awesome, you got to spend some time at both those things. Okay, my third investment theme before Terry makes me have some forecasts is something I call Scamgate. Financial scams and fraud, they've always been a mainstay of society. I actually looked this up in research. I found it pretty fascinating. The first case of a financial scam actually happened in 300 BC. This is true. You can look up 300 BC. There was a Greek merchant that took out an insurance policy on a cargo shipment of corn. And this guy was going to keep the corn, sink the ship, and collect the insurance policy. 300 BC. Oh, by the way, it didn't work, and he drowned when everyone else on the ship saw it. So all these scams don't work, but they're pretty creative ideas if you think about it. Now, this current explosion that we're faced with, a financial scam, is the result. There's a confluence of three things happening that really is encouraging this in a really big way. First is the continued explosion of technology and the use of this state-of-the-art technology for almost all of our daily financial and investment transactions. They're all done online, basically. The second thing is what I'll call the continued global connectivity. Look at, we live in a world that instead of like going to your neighborhood and shopping in a garage sale, you go online and buy something from Liechtenstein. That's what people do. You can buy anything from anyone, anywhere in the world. That increases the potential for fraud and scam. And the third issue is, it's the aging demographics of the developed world. The fact of the matter is, these senior citizens aren't as sharp and aren't as savvy as they once were. And they also find themselves sitting on more accumulated assets than they ever thought they were going to have. So it's that combination that has increased this. Now, the most notorious cases of corporate scams and fraud in the previous generation, you all know them by heart. It's Enron, it's WorldCom, it's Bernie Madoff. But today we have our own set of corporate fraud with WeWorks and what Terry mentioned earlier, the cryptocurrency exchange, FTX. Here's what the Department of Justice said about FTX's collapse, and I quote, "The single fastest big corporate failure in the history of America." I mean, it's mind-boggling that that's still going on right now. So while financial scams and fraud aren't new, what's the most alarming and what I think we have to pay such close attention to is it's so much more costly now. According to the Federal Trade Commission, American consumers lost $5.8 billion to financial scams and frauds in 2021. That's a 70% increase from the prior year. Those numbers, they don't even include identity theft. So the number's probably even greater than that. Now, this rapid increase in these financial scams and financial frauds really is twofold. One is we all have this newfound fear and confusion as to what the rules are. We don't know anymore post-COVID, because post-COVID, everything's been turned upside down. The way things used to work, they don't work anymore, so everyone's confused on how things are supposed to be. And the second reason for that explosion is imposter scams. Now it's the most prevalent form of scam and fraud that's out there. Imposter scams, they cost victims between $1,000, $3,000. They always target the elderly. Now, the trends in scams are going to continue. There's a lack of regulatory oversight in cryptocurrency, in global interconnectivity. And then you think about the amount of personal information that's widely available on the internet. It's that combination that's out there. So if I could give you any piece of advice, it would be, please, don't extend your car warranty when they call you tonight. Just no matter how good it sounds, just don't do it. Okay. My fourth and final investment theme is called We're Back. The We're Back I'm referring to are bond vigilantes. Now, the term bond vigilante was actually coined in the late 1980s by my good friend and fellow Deutsche Bank employee, Ed Yardeni. He was actually the chief economist at the time. A bond vigilante refers to a bond investor who either threatens to sell the bonds, either actually sells the bonds, or avoids buying a large amount of bonds in order to protest disagreement with the policy of the issuer. Now, this behavior, if successful, can result in higher borrowing costs to that issue, or whether it's a government or a corporation. But if you get enough people to follow you, it could have really higher borrowing costs. It could force the entity into distress. It could force you to change the policy, and you could end up having to pay a higher rate of return to compensate for that increased perceived risk of the bond vigilantes. Now, most investors, myself included, I thought they were gone. I thought we got rid of bond vigilantes over the last decade, and that's because we had zero to low interest rates and increased central bank intervention. However, I was wrong. Bond vigilantes were not gone, they were only in hibernation. And now, the result of higher inflation and higher interest rates, they have woken back up. Probably the best example and latest episode of this bond vigilante occurred, as Diane was referencing, in the United Kingdom when then Prime Minister Liz Truss announced her economic plan. She said, okay, here's my plan. Bond investors took one look at it and said, oh my gosh, they took the 30-year UK bond and took it from trading under 3.5% to over 5%. Caused the Bank of England to jump in, intervene the bond market. Several pension funds were worried. You had insurance companies about to go under. And as a result, Liz Truss's reign as Prime Minister lasted all of 45 days because of the bond vigilantes not agreeing with that policy. Now, I would urge you, pay close attention to corporate America and corporate bonds over the next year, over the next 18 months, because bond vigilantism is going to rear its head right here. Here's the reason. It had huge amounts of monetary and fiscal stimulus released during the pandemic. During COVID, we witnessed unprecedented actions by the Federal Reserve. While necessary at the time, it had the unintended consequence of keeping many, what I'll call near-dead companies from failing. At Deutsche Bank, we used to call these companies zombie companies, okay? And these zombie companies, better beware, because the living dead does not walk forever. That's the end of my prepared remarks, and I would be...
Whoa! So, wait. Bear with us for 1 minute, because I want to get your fill in the blanks, and then we'll have time for just no questions, but one last word. But the Dow. We're at 401k. What, Bob?
Well, 401k is not 41,000. So just so we're clear, it's 40,100.
It was 40,
and I think I'm going to try that one this year. So I'm going to look at. I feel really comfortable that the Dow's going to be at 39,000. That would be like my official forecast. But if it gets to 39,000, I know it's going to go to 40,000, and then I'm going to say, dang it, I should have just said 401k. So even though officially my forecast is 39,000, I actually do think it's going to break 40.
Whoa. Interest rates, 10-year.
You know, I think there'll be maybe 3.25, could trend to 3, but I'm more comfortable like in that 3.25 range.
Dr. Bob, are we having a recession this year?
No.
No?
No.
Just like no? Just no? Is inflation going to be beaten down?
I think the inflation story, John was so spot on last year, and spot on with so many of the things he talked about, as did Diane. It's a pleasure to be on the stage with some people that are right. Anyway, it was, look, I think inflation does get better, but, where I think the wild card is, I don't know if that getting better is enough to stop the Fed. So to me, that's the dynamic. I feel really good that we are heading down the path doing the right thing, but I'm not sure if we can do it good enough, fast enough to get them to
All
stop
right,
raising rates?
$100,000, Dr. Bob.
Oh, give it to John. I mean, this is a no-brainer. I mean, I would. Are you kidding me? I mean, I was.
You want to go with that?
I wasn't
Is that
born
your
yesterday.
final-
This is like the easiest decision you ever make in your life.
Is that your final answer?
That's my final
You're
answer.
Giving it to John. John, we're going to mark the Ariel Fund to the market. Let me say this. You know, impossible to do questions with all of you out there, but I hope you got most of your questions answered. We had a resounding no recession from John and Dr. Bob and a mild recession from Diane. Diane's cool with the markets, and John thinks it could be 10% plus on the Dow. And Dr. Bob was officially going for 39,000. I'll be rooting for 40,100. Nobody's particularly worried about interest rates soaring. Nobody seems to be particularly worried about inflation going upward and out of control. And everybody thinks it's going to be a little tough to get it under control. Meanwhile, the Fed will do what it's going to do. And we've got some great investment suggestions. Diane's in cash and treasuries. Figures 6 months will be the time to maybe move out to a longer maturity. John, American domestic equity, all in. And Dr. Bob's all in with John. On that note, we invite you back next year. I'm going to turn this podium over to Margaret. But thank you all for being such a great audience. Really, thank you.
That's it. I know we went a little bit over. Thank you all for hanging in there. Have a great day. Thanks for being here.